chief investment officer, whatever title you want to go with today of ARPG in Las Vegas. Matt, how was Tahoe, man? I missed you last week. It was little odd to go through a Friday without seeing that beautiful shining face under that perfect little helmet head of hair.
You know what? I was at a place where you would have been incredibly jealous. It was the perfect place for me to be on a Friday last week. I was at the Edgewood Resort in Tahoe, right where they're having the American Century Classic right now.
Oh, wow.
It is. Yeah. And our room, it was beautiful. Last year, our room was on the 9th hole, which is their signature hole, which is right there on the lake. Just a phenomenal resort. Great service, just great property, good food, great time. They have a wonderful 4th of July barbecue there they do fireworks right there on the lake. It's just an incredible place. So, obviously they blocked the whole place out for the American Century Classic, but we wanted to be in the 4th. We had a wonderful time. But yes, my Friday was thinking, it'd be a lot better if Garrett was here. He'd be golfing right now.
Absolutely. Yeah.
I don't even golf.
I didn't get to play golf on the 4th of July. I get to play right now. It's kind of funny this year, actually. Usually summertime is a chance for me to get to play a lot of golf, but my kids being out of school has kind of thrown that way off, and they're at the age now where there's no daycare or anything, right? They're just kind of hanging out, and I want the time with them. So usually I play a lot more golf in the summertime, and this year I pretty much put the clubs away. I get to play twice. I get to play Wednesday and Thursday every other week. Those are my two free days. I did get to play this week, and then I just put them up and probably won't see them again for 2 more weeks now. So yeah, would love to have been there.
Well, one of these days, you're really gonna have to make it out here to Vegas. We'll have to do a live show, right? This is live. We do this live. We'll have to do a show live together, and here in the room, here in the conference room, here in the war room, the operations room, conference room, right? And then we'll go golfing. I don't golf, but both of my advisors golf, and we'll all go golfing, and I'll be waiting for you guys at the 19th hole.
I was like, do you play at all? So you never don't even know how to swing a club? Basically?
No. I it's a gentleman's sport, and I'm hardly a gentleman.
That is a very, I don't know. It's becoming less of a gentleman's sport, though. I feel like there's been since COVID, man. I was talking to somebody the other day about that. The world has changed so much since COVID, and I don't think this is necessarily COVID related, but sometime around that time frame is when people started bringing speakers out to the golf course and started turning into a big party. So it's not quite as much of a gentleman's game as it once was, but that's cool. I enjoy it that way. So anyway, how about some investment stuff? So we're pretty much shooting from the hip today. We haven't had a pre-production call or anything like that. I kind of like it better that way anyway, though. I think it's we're a little bit more raw and candid and unpredictable. But you did tee this one question up for me in pre-production, which was basically 5 minutes ago. Is the market too expensive? We're at 62.66 at this very moment, 109 Eastern Time, July 11th, 2025. That is another all-time. Well, it's technically not all-time high because it was a little higher yesterday. But 62.66. Are we expensive?
By historical standards, absolutely. I believe we're at the 98th decile. We are right up there.
That's getting up there. You're running out of room to get much higher.
We are running out of room. Yeah. So I think it's important that before we say, is the market expensive or is it cheap or whatever, we need to peek under the hood and take a look at what the S&P is, how it's made up, right? And kind of deconstruct.
Are you saying we should do some objective analysis?
We should do some optimistic objective analysis.
There we go. Okay. So we're not just going to just spout off whatever comes to mind. We're actually going to put some data behind our thoughts and opinions.
We're going to put some data behind this, and we're gonna do a Babe Ruth kind of point over center field here at the end of the show. We have a new prediction coming out, and I think there's a lot more left in this market than people give it credit for. Okay.
Do me a favor real quick. Slide about 6 inches to your right. There we go.
Yeah, right there?
Now I get to see you a little better.
So I think this market has a lot more in the tank than people think it does. Not that it won't have fits and starts. Not that it won't have a bumpy road here and there. Of course it will. In fact, we are getting into that. We're getting into that time of year where, July always seems to start off like a rocket ship and just kind of lay over the very end. Then we get into the August, September doldrums, and then we get some sort of inflection point sometime in October, sometimes the beginning of October, middle or end of October, or it flex and takes off into the end of the year, and we get that sort of that end of the year, those end of the year rallies, which is a very seasonably good time, right? We're coming into a seasonally tough time in about 4 weeks or so. Things are going to start to change a little bit, right? There's always some catalyst that brings that market down. You name it. Whether it's the Fed, the rates themselves, tariffs. This time, I believe it will be both tariffs and interest rates. Okay. So, but back to what we were talking about as far as, is the market expensive or is it not expensive? So sitting at 22.24 times earnings, that's very expensive. The 5-year average is 20 times earnings. The 10-year average is about 18.6. Okay. So it is expensive on historical metrics. So let's take the S&P and let's kind of blow it apart a little bit. Okay. And let's look at the S&P 500 as if it on an equal weighted basis. So no one company has any more influence on the market, on the indice, than any other company. If you look at it,
let's explain that really quick for those who might be newer to the show or may not necessarily keep up with that. So the S&P 500 is a market cap weighted index, which means the largest company in terms of market capitalization, which is total value of the company in the open market, is going to, you may have the data right in front of you, whatever the biggest company in the world is, if it's 5% of the overall, it's 5% of the market capitalization of the S&P 500, then it's going to carry a 5% weighting, even though there's 500 companies. So theoretically, even equally weighted, it would be 0.2% of the index, but it's going to carry a bigger weight because it's a bigger company. So equal weighted has those 500 biggest companies that make it up, but each individual company is only making up 0.2% of the overall
Correct.
index.
So let's compare NVIDIA and Netflix. Okay, just to make it easy. NVIDIA is 7.5% of the S&P. Its market cap represents 7.5% of the S&P 500's total market cap. Market's total market cap is about 57 trillion. NVIDIA is right at 4 trillion now. Okay, now Netflix is exactly 1% of the S&P. Okay, so what that means is the market cap of NVIDIA has 7.5 times the influence on the multiple of the market than does Netflix, right? So NVIDIA has 7.5 times more influence on that multiple than does Netflix. That's what that means, because one's 7.5%, the other one's 1%. Whereas on the equal weighted side, they both have a 0.2% of influence. They're completely equal. There is no differential. Okay, so it's important to look at that equal weight from a perspective. Is the entire market expensive, or is it just a few pockets of the market that are expensive? And do those pockets of the market deserve that multiple? Right? That's what we need to look at. So we're looking at a 22.25 times multiple right now. Okay, that is expensive. But if you look at the equal weight, it's at 17 times. It is actually below its 5-year average. Okay, it's 17.01 as we sit here today. Before, in January of 2019, it was at 17.5 times. Okay, so we haven't seen the underpinnings of the market really explode in multiple at all. Okay, and even back then we had very low interest rates. Although we have higher interest rates now, we're actually seeing a slightly lower multiple, but not by that much. Okay, so what does that tell us? It tells us, okay, there's for us to be at a very historically high multiple on a cap weighted, but be below its 5-year average on an equal weight and below where it was before COVID, must be some outlying idiosyncratic companies or sectors that are kind of lifting the multiple as a whole. And that's where you have to look at, okay, how big are the actual sectors of this market? Okay, 10 years ago, the tech sector was 20% of the market. It's 20% of the S&P, 23% of the S&P. It's 33% of the S&P now. Okay, it represents 1/3 of the S&P 500. The market cap of the 70 companies in the tech sector represent 1/3 of all of the market cap. That's how big tech is. Okay, so you're talking about a company, you're talking about a sector that only represents 14% of all the companies in the market. Okay, but they represent 33% of all the market cap of the market, right? So they're basically almost 2.5 times the size of the average S&P 500 company as far as market cap goes. Okay, that's what tech is, and it's obviously, of course, it's largely the tech sector that's lifting this multiple up. Fine. So is the tech sector deserving of that, of whatever it's doing, and what does that multiple look like? Okay, so ProShares has an interesting ETF. It's called the SPXT. Okay, and what that is it's the S&P 500 X Tech. It's basically 430 companies of the S&P 500 on a cap weighted basis, not an equal weighted, but on a cap weighted basis, and that's what that does. So I was able to kind of look at that and look at that growth rate and look at that multiple and take a look and see what it looks like. And it's very, very healthy, actually. I mean, we're looking at the SPXT. So all of the companies in the S&P 500 X Tech are growing at about 12.5%, 12.3 to be precise. Okay. Now, it's sitting at 18.5 times earnings. There is nothing wrong with an 18.5 multiple with a 12.5% growth rate. You're looking at that's a 1.51 ratio. It's a 1.51 price to earnings growth ratio. That is as healthy as a horse on Sunday. Okay. I mean, yes, it can get better than that, but that is a nice, healthy growth to multiple ratio. Okay. So let's just so now we know what the S&P looks like with no tech in it. What does just the tech sector look like? Okay. The tech sector in and of itself is growing at 17.5%. It's great. Of all 70 companies, there's some that are doing really, really well, some that are not. Okay. And this includes Apple and Microsoft, and they're growing at like 7-8%. Okay. So there's some laggards in there too. Okay. But they're still growing at 17.5%. And they have a 25.9 multiple, call it a 26 multiple. So if you take the 25.9 multiple on a 17.1% growth rate, guess what that price to growth ratio is? 1.51. It's precisely what the rest of the market is. Okay. So it's incredibly healthy. So if you look at the size of tech and what it's grown into and its current growth rate, right, and its multiple that you're paying just for that tech, and you fold that in, it's actually a very healthy ratio in altogether. So I think there's quite a bit more gas in the tank here. Don't get me wrong, there are expensive companies, okay, and there are cheap companies, okay, and how we decide what a cheap company is or what an expensive company is we discount the future cash flow to today's price, like you're supposed to do. What is the future value? What is the future value of those cash flows? Okay, so let's take 3 companies. Let's take NVIDIA, Microsoft, and Apple. Number 1, number 2, number 3 on the S&P. Okay, as far as cap goes. Okay, NVIDIA is 7.5% of the S&P. Microsoft is number 2 at exactly 6%. Okay, I'm sorry, at exactly 7%. NVIDIA is 7.5. Microsoft is 7, and Apple is 6. Okay. Of those 3, Apple sits at 28 times earnings. Microsoft sits at 33 times earnings, and NVIDIA sits at 33.2 times earnings. Okay. So Microsoft and NVIDIA have identical price multiples. Okay. Apple is at 28 times earnings. It's the cheapest, and it's also the most expensive. Okay. In my opinion, it's by far the most expensive. Huh?
You said Microsoft and NVIDIA have identical multiples?
Price multiples.
Okay, I thought you.
But they have
Maybe I
wildly
misheard
different
you.
growth trajectories.
Okay, maybe I misheard you. I thought you said Microsoft was 23 and Nvidia was 33.
Nope. Microsoft is 33 and NVIDIA is 33.2.
Okay, gotcha.
Okay. And Apple is 28.
See, that's why I didn't do well in school. I don't take good notes.
So Apple is by far the most expensive of the three, even though it has the lowest multiple. So now you can tip over and start drooling, going, what does that mean? So if you look at Apple at 28 times earnings, they have a 7.7% growth rate. That's it. Okay. So you're looking at basically a 3.5 PEG ratio. So their growth to multiple ratio is 3.5 times. That's very, very high. On top of that, their innovation, to say it lightly, the last 5 years has been lacking. Okay. And they're also subject, because they're a hardware company, they actually make devices, they make computers, they make phones, they make the iPads, they make the AirPods, they make all these other things. They're subject to commodity risk. They're subject to currency risk. As they're needing to buy parts for their different devices and have them made elsewhere, there's more subject to tariffs and things like that as well. Okay. What that gets into margin. Okay. So there's a lot more margin risk with Apple than there is with the other two. And if you look at their gross margin at 42.7% and their net margin at 24.3%, it's good. It's not great, but it's fine. There's nothing wrong with it. But 28 times earnings with a 24% net margin at a 7.5% growth rate, that's expensive to me, because you have to do a lot of sales at a 24% growth rate, okay, to make your earnings. I'm sorry, a 24% net margin to really make your earnings. Okay. So let's look at Microsoft. 33 times earnings, has a 7% growth rate, identical growth rate to Apple, about 7.5%. Okay. But they have a 69% gross margin and a 35% net margin. So they have a 50% higher net margin, both gross and net margin, than does Apple. So they have to do less sales for those earnings to grow. So if they do have an upside surprise in sales, right, their earnings are absolutely going to take up because they have a better margin. They have a much bigger margin cushion than does Apple. So they deserve that higher multiple. And that's what I would say is a fairly priced-ish, leaning into good buy. Okay, much more so than Apple. Well, then you have NVIDIA. NVIDIA is at 33.2. It's technically the most expensive of the three. It's also by far the most cheapest of the three. Now go choke yourself with your tie. If we had ties today. We don't have ties today.
We rarely wear ties.
I think we're going to have ties in a couple of weeks. We're going to do our.
It's coming up. Our
it's coming
week
up.
is coming up. Yeah.
It's coming up. Our buttoned up version is coming up. So so NVIDIA is running at about a 30% growth rate. 30. So we're running 4 times the growth rate of the other two. Okay. But it's the same multiple. Okay. So you actually have a growth rate that equals the price multiple, about 33%. Okay. On top of that, you have the same margins that Microsoft showed, about 67% on the gross margin for NVIDIA, but it has a higher net margin, like 37% net margin on NVIDIA. So what's happening is the reason they keep blowing out their earnings numbers is because as sales increase just slightly, because their net margins are so good, their earnings just go parabolic. Their earnings growth goes parabolic very, 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 very quickly. And you have to have margin. You just have to have that margin. Now, don't get me wrong, there's a lot of risk involved with China and tariffs and there's a lot of sovereign risk actually involved with the United States not wanting certain source codes and AI codes type chips shared with other companies, especially adversarial companies like China. So there's that risk there, but I think a lot of that's baked in. I would think at a 33 multiple with a company that's shown that kind of sustainable growth rate, it's the largest company by market cap in the world with a balance sheet like that. I mean, again, it's one of these generational layups. So I think there's a lot more in this tank as far as earnings growth on that tech side, and I still think we're in this AI bull market. I think this is a long. I think it has a long way to go. I think we're just getting started. Don't get me wrong. I think there's going to be fits and starts. What do we have next year, right? What is next year? Next year is the midterm year, right? So if you take each year and you chop it in half, you get 8 half years of a 4-year presidential cycle. The first half of that midterm year is always the worst of the 8. Do we remember the first half of 2022? Right? Wasn't good. 2018,
try not to.
not so good.
We try not to remember it.
So we're coming into some cycles that might not be great. Okay, so there, of course, so it won't be a straight line. It never is. But I think these earnings are really going to catch up faster than people think, and I think it's gonna hold that. Don't get me wrong. I think it's going to hold that multiple somewhat in check, because I think the market's going to continue to grow, but I think the earnings are actually going to follow along with it. But then that gets us into our sort of a version 2 of this. Is I think the market needs to. I think the investors and the market need to start becoming okay with we're living in a different multiple regime. Okay, because for years and years we had the S&P was an industrial based index. We had tech, it had industrial, it had financials. It generally grew by about 8%, 6%, 9%. And so it lived at a 16, 18 multiple in the good years, 19 multiple in the good years. And that's what it deserved. It was growing at 8%. And tech was a very small portion of it. Now tech is, a third of it. I think in 10 years, tech is going to be 50% of the S&P index. Okay. So if we have being that it's already a third of the index and it's growing by 18%, okay, that tells you the whole market, the market in and of itself, the entire S&P is just going to live at a higher multiple because the S&P on a cap weighted basis is growing much faster, certainly growing much faster than Europe.
So I have a question here. This is a little bit of you've tap danced around this a little bit. So it's not like a total curveball, but we haven't discussed it before. So it's a little bit of a curveball. When you're looking at growth rates, one of the things that I, back in my playing days in this industry, when I was managing portfolios, I did a decent amount of stock picking, and the G component of the PEG ratio, the growth component, was one that I toyed around a little bit with. Okay, which number should I go off of here? Because there's earnings growth, which is the generally accepted concept around the across the industry. When we talk about the growth rate of a company, we're usually looking at the earnings growth, but that can be a little bit misleading occasionally because there are some companies in the index that will have negative earnings. And boy, that can really throw things off a little bit in your spreadsheets when you're trying to spreadsheet all this stuff out. But the other reason it can throw things off is that revenue growth, at the end of the day, this question, what I'm asking is, which is more important, do you think, revenue growth versus earnings growth? Or is it may not be a which is better, it's just understanding the difference between the two. And I'm going to do some math here, but while you were talking, I went ahead and jotted it down and pre-calculated it, so hopefully I don't screw anything up here. If I have a company that makes $100 and it gross revenue, and it costs me $50 in expenses to produce that, I have $50 in net profit. If I can cut my expenses to $25, now my net earnings are $75. That's a 50% increase in earnings, but I haven't grown revenue at all. But on the other side of that, if my expenses stay the same at 50, but I grow my revenue from $100 to $200, now I've seen a 200% increase, or I've tripled my net profit from growing the top line as opposed to cutting the bottom line. And ultimately, if your earnings growth is coming from cost savings, there is a limit to that. You can never go above zero or below zero in your costs. At some point or another, you are gonna hit the rev limiter, so to speak, on that. But if you're growing your revenue, sky's the limit, right? So to me, when we talk about, I think I may have even done this when I was analyzing individual stocks. I think I would try to find a revenue growth projection instead of an earnings growth projection, because I felt like it was a more level playing field. But at the same time, if a company is growing their revenue and growing their expenses, if they have terrible margins, right? So yes, I'm making $500 extra, but it's costing me $490 to produce that, then that's not as valuable to me as someone like Nvidia with fat margins. So how do you take all that little dialogue right there, but and turn it into some type of information for our viewers? But how do you dissect that?
Well, that's margin. That's where when we visited margin just a few minutes ago. You look at companies with a high gross margin number and high net margin numbers, there's not a lot more meat on that bone. Okay. These are very well managed companies. These are very efficiently managed companies. So you look at a company like Nvidia, or a company like Microsoft, they have all the efficiencies built in. So again, back to why we use your bigger blue chip solid companies with solid guidance and lots of data around them that have been doing it for a long time. You're not going to, if you're seeing earnings growth, that's coming from top line sales growth for the most part. Okay. Yes, there are certain things that can happen. Obviously, a tax cut can come in and change down the income stream and bring earnings up, or a tax increase can come happen and bring earnings down. They can move their headquarters from California to Kansas and bring earnings up slightly. But companies of this size, the only thing that really moves their earnings needle in a material way is sales, right? And margin. So sales and margin. So as long as, if you look at Apple, we're looking at a 43% gross margin and a 24% net margin. That's an expensive company. Now, is there room inside of that company where they could bring those margins up, not increase gross sales, but bring those earnings up by bringing those margins up? Potentially, but the market is penalizing them right now. They're 28 times earnings versus the other two at 33. So, that's where we get into, that's where we start to look. You have to look under the hood and look at the quality of the company and how it's being managed. The other thing is all else aside, there's multiple ways you can look at things, but you always have to go back to the historical correlations, right? Earnings historically correlate to price 95%, not sales, not margin, earnings. However that earnings number gets there, that's the correlation. So I don't need to reinvent the wheel. I don't need to come up with a new theory of relativity here. That's the correlated number. Okay. So as long as we have gross margin, somewhere above 50, 55, we have net margin somewhere above 30. Okay. Those are very efficient companies. Okay. So is there a little bit there? Maybe. Is it going to move their earnings needle? No, not enough. Okay. But to your point, you are right. You have that. The sales number is very important because it's that number that moves that earnings number in a material way that would actually move the share price up. Yeah. So, and I think a good example of this is Europe, and I kind of alluded to this earlier, that you look at the Eurozone GDP and the US GDP, the only company with the only, I guess, economic country or region in the world that has a larger GDP than the United States is the Eurozone as a whole. The Eurozone GDP was slightly larger by like 3% over the US GDP. Okay. Now there's 880 million people over there versus our 340 million people over here. Okay. But they're slightly larger. We will overtake their GDP, I believe, next year. Okay. So JB Diamond just came out with something the other day, and he says that, Europe is going to be about 2/3 of our GDP in about 10 years. Okay. Because I think they do. I'm not sure what their margins look like, but they don't grow sales. They don't grow sales over there. They have all these programs over there, all these social programs. They don't grow sales. So, as you're looking at earnings growth and you're looking at market cap growth, you're looking at, GDP expansion. Okay. That's where that comes from. So, I think the U.S., is absolutely, going to remain the leader here. And I think it's coming from the tech sector. And, we also don't have all of the ducks in a row right now for this market to really take off, but I think it's getting there. Okay. Waller came out today, Chairman, the New York Fed President Waller Again, he's one of the 3 permanent voting members. He came out today and said, this is not political. This is economic. We need to lower rates. We need to lower them now. That was today from Chris Waller. And he is my pick to be the next Fed chair over Kevin Harsh, over Kevin Hassett. Although they seem to be toyed around as the choice for Trump right now, I think Waller will be the chosen one because he brings a tremendous amount of credibility to that pick. Okay. And I think we're going to get a cut in July. I really do. I think we're going to get a cut. If we don't get a cut, I bet you we'll get at least 4 dissents. We'll get at least 4 dissents. So I think we're going to see a cut. The other thing is if you look at Kevin Harsh, or Chris Waller, any 3 of those, or even Michelle Bowman, any 3 of those who have not been a fan of it in the past, she has been incredibly hawkish for no reason. Now all of a sudden she's dovish, so who knows? So she might be a little political. I'm not sure. But I think the market's really going to start pricing in a much more dovish Fed in early 2026, mid 2026. And again, we're going to start seeing that reflected in the bond market here pretty soon. We had a great 10-year Treasury auction yesterday. We saw the 10-year come down to, the low 430s, back up to 441 today, obviously because of the Canada-Brazil tariff scares. Okay. But I think that's going to come back down. So, as we start to look at these growth rates, these earnings growth rates in the tech sector, and we really start to peek under the hood and say, okay, well, the market in and of itself, ex tech and tech by itself, is running about a 1.5% PEG ratio, which is solid growth rates, fair multiples, and we are going into a very likely a lower interest rate environment, okay, with a very pro-business president, okay. So my prediction for the year, I think the tale of 2 markets, it exists, but we are favoring heavily our 6,900 number, but we're going to add a 375 10-year to it.
Okay. All right.
Okay.
So
I think we're going to see the bond market get ahead of this. We're going to have a 375 10-year with about a 6,900 S&P at the end of this year. And then what will happen is we'll have a very tight banjo string. We'll have lower rates. We'll have extended earnings multiples. And we're going to go into that first half of that mid-year, that midterm year. And I think the first half of next year will be choppy like a chef's kitchen.
I mean, you're going big time on the predictions. You're not just calling your shot, but you're calling exactly how far it's going to fly, exactly which seat or which row it's going to land in. I mean, you're going all out here. Does the market?
We're nothing but precise here, right?
That's right.
So
we may not be.
We're going to be incredible. Now we're going to be. Now look how wrong I was. I'm going to precisely tell you how wrong you were.
Yeah, that's right. We're gonna have a lot to go back and chew on this one. Does the market know? I'm going to say this in a very arrogant way. Does the market know that the Fed's cutting in July? You know it. Does the market know it yet?
Nope. No, the CME is at 7%. I'm one of the 7%.
Hey, you know what? If you can't stand out, I mean, dare to be different. That's what I love about you.
Well, whether they do or they don't, they should.
Yeah.
So,
well, as always, we're here just for your entertainment and amusement. We're not telling you what to do with your money. Matt could be wrong. I mean, it's.
Oh, I will be wrong. No, right? I'm going to be wrong. But how wrong will I be?
There you go.
And what degree of wrong will I be?
Yeah, that's right. One of the keys in investing. It's funny. We started talking about golf. Golf is one of the greatest golf books probably ever written is called Golf is Not a Game of Perfect. It's a sports psychologist that's talking about the mental side of golf, and golf is a game that good players just make better mistakes than bad players is maybe the way to say
True.
it. Same thing with investing. It's not about being right all the time. It's about making your mistakes very small and I can't even say infrequent, because even good investors are going to be wrong a fair amount of the time, but don't lose half your portfolio when you're wrong.
Well, there's an old saying, and with money managers, the best in the world, they bat 600.
Yep, that's about what I've always heard.
They bat 600 year over year. Took what you bought, was 60% of those positions positive, or at least better than the market, right? Yeah. So
that's what I've always heard. That's the standard industry consensus, I guess, is that, and that's the best money managers. We're not talking about every advisor out there, every investor out there. The best money managers bat 600. That's That's humbling. We talk about humility sometimes. That's pretty humbling. You're going to be wrong almost as much as you're right. So how do you succeed despite that? That's a big lesson to learn. If you would like to speak with Matt and his team, you can reach them at, well, first we can go to the website, intelligentinvestment.com, or give them a call at 702-655-8300. Joke around about it a lot, but Matt and his team are, I got to hear you chat with one of your guys right before we hit record there. You were still getting data together right before we got on here. So sharp guys over there. Enjoy having.
They're the best. I got some good people here.
Yeah, awesome stuff, man. Well, enjoy your weekend, and we'll see you next week. Good to be back, man. Missed you last week. Good to see you.
All right, we'll see you soon.
See you, bud.